Every year the market offers guidance to us if we just learn to listen. With that, I give you the top 10 lessons of 2007. Lesson number 10. The Iron Condor can still be traded in a high volatility environment. We just need a little bit more patience. We have to enter the topside trades on breakouts up against resistance and enter the downside trades on breakdowns into support with bullish divergences showing. Lesson number 9. Not all brokers handle the Russell 2000 spreads in the same manner. Some brokers default their Russell orders to the CBOE exchange. This defeats the purpose of having a multi-exchange traded instrument. If you trade the Russell 2000 or the RUT, check with your broker to see how they route the orders. Lesson number 8. Stop limit orders help the retail trader, but don't use them in quiet markets. Stop limit orders are an answer for the requirements of most retail traders that can't be in front of their screen at all times during the day. They allow an unattended exit of a spread order at your maximum debit that you define. These are very useful for ETFs due to the narrow spreads that they feature, but you cannot use these with the larger index products, as we've used for years. In quiet markets when no one is trading, though, even ETFs can get picked off, so use those with caution. Lesson number 7. Never ever hold a euro settled index product over expiry. The European settlement process with index products like the SPX, the RUT, the DJX, etc. use the European cash settlement. It's not the price of where the index stops trading on Thursday of expiration week, but where it settles on Friday morning's opening print of all the stock prices. Prior to August 2007, a 10 to 15 point cushion was adequate to be able to hold a position over expiry with some confidence. But August 2000 settlements gap was about 40 points. Lesson number 6. You can get nearly free exit with some brokers. Some brokers will allow you to buy back the short option for no commission costs if the price for that option is 5 cents or less. Buying back the short option relieves your short option obligation. You're no longer on the hook. You can then immediately place an order to sell the remaining long option for 5 cents, effectively canceling out the cost of that. The only cost that you have then are the commissions for the long option sale, which will be charged. In this manner, you can reduce risk and save money at the same time. Lesson number 5. Watch the pre-market index futures. Understanding where the futures contracts are trading before the 9:30 a.m. Eastern Time cash open lets you know the opening bias for the market that you're trading. Watching these pre-market futures allowed us to remove a downside order that we had on February 27th before the market lost 50 points in the S&Ps that day, as well as allowed us to improve our orders several times since then, improving them either getting a bigger credit or pushing them one strike further out of the money. Lesson number 4. Use positive gamma spread positions to help defend trades. Vertical spreads such as bear call spreads and bull put spreads are negative gamma positions. That means that they lose value as the price runs towards it. But we can use positive gamma positions like a butterfly spread to help defend these spreads. Positive gamma positions like butterflies gain value as the price moves towards the center strike. So it's a very useful insurance trade to help defend your vertical spreads. Lesson number 3. ETF options defend better than the large index options. For the past year, I've been trading alternative products to help create trades for those with smaller accounts. The ETFs like the IWM for the Russell and the SPY for the S&P 500 have done much better in not requiring an exit with some of the large moves that we've endured in 2007. And the lesson here is it's not about what you earn on the trade, since you can probably get a higher rate of return with the larger index products. It's what you keep. Defense is everything in this volatile market. Lesson number 2. Make sure that your rule set is constantly tuned to match the current market. This was mostly a lesson that we had to learn in late 2006, but it still resonates with me today. The market is always changing its dynamics. It's different now than it was at the very beginning of 2007. So it's mandatory for you to review your results every month and make sure that your rule set is in tune with what the market is doing. You can watch me do that every month as I go through this process in the newsletter. For example, the emphasis in 2005 was in maximizing credit and opportunities. The emphasis now in 2007 has been defending trades and using tighter instruments, just like the ETFs that we had discussed earlier. And now lesson number 1 is that the SPX no longer gives the retail investor an edge, which is why I no longer trade it. Here's a picture of the SPX pit, and this is some of the most expensive real estate in the world, and it's really more for the institutional investor. This is not a product for the retail investor anymore. Not that it really ever was. But with the advent of some of the tighter ETF spreads that are out there that are penny wide, those are the index products that you should be trading. So the SPX has always been my favorite chart. In the days of lower volatility, we gained an edge trading the SPX by being able to negotiate better credits. We got literally credit out of thin air with this instrument. Forced exits were rare. We didn't care that much about defense as we cared about getting into a great trade. Now with higher volatility that we've seen over the last few months, spreads get widened out to ridiculous levels with no transparency to the retail trader. You don't know what it costs you to get out of that trade. So wide spreads are actually necessary for these institutional traders to not move the market, so they can put a large order inside the spread and not telegraph their intentions. Otherwise, with a penny wide spread, they'd be moving that market very, very quickly. This, however, works against the retail trader that has no floor access. If you're not down in there in the middle of the pit, you have no clue in what it is. And phone calls and time are necessary to be able to understand what the price discovery is. So that's my top 10 list for 2007. There are many more lessons for that. You have to read the newsletter for those. So thanks for watching. I'm looking forward to another great non-directional year in the market. And for all of you, have a safe, happy New Year's. We'll talk to you soon.